Among the damage Russia's invasion of Ukraine has done, it has shuttered many of the region's factories, mines, and other businesses, where key materials are made for industries around the world. It has imperiled the livelihoods of the people in the region and sent companies scrambling once again to rebalance their supply chains. In March of 2022, S&P Global Mobility cut its global auto production forecast by 2.6 million vehicles in both 2022 and 2023. The worst-case scenario totaled as much as 4 million lost vehicles.
Reportedly, Europe was down. They cut by 9%. So around 1 million cars or so coming entirely from cuts in Europe.
Separately, S&P Global Credit analysts also forecasted that in 2022, auto sales will drop 2% below 2021 levels. That is a significant decline from the 4 to 6% rise in sales the group had last predicted in October 2021. While demand declines in Russia and Ukraine are partly responsible, the two countries together form a tiny share of global light vehicle sales and production, only about 2% in 2021. The bigger concern is the shortages of materials and parts that are already hitting European automakers. The report warned these could well spread to other markets if the war continues. European carmakers have already, at least temporarily, idled production at several factories. The report highlighted disruptions to supply of critical automotive parts from the region, perhaps most notably wire harnesses from Ukraine. At risk are also supplies of raw materials such as palladium and price hikes for steel, copper, aluminum, and nickel. All of these are key materials used to make cars. Hit hard has been the production of an essential component that consumers cannot see: wiring harnesses.
A wiring harness is the central nervous system of an automobile.
There are a couple dozen of them in a car, and they bundle all the wires that are used to connect just about everything to just about everything else.
It basically moves information and power to all the components of the vehicle that have to work seamlessly to make sure that car goes safely down the road.
And they are absolutely essential. As one opinion piece in trade publication Automotive News put it, an automaker can build a car without some of its chips. It cannot build a car without wire harnesses.
Without that wiring system, the car does not move. So it's a really critical part to the manufacturing operations of the vehicle.
Wire harnesses are tricky to produce.
It's very difficult to automate. You're winding these things together, laying it out on a big loom. It's highly dexterous work. So because the labor is such a big part of the cost of it, you look for where is the lowest cost labor. But then you also want it somewhat close to your production sites. These are not terribly expensive things, so you don't want to be paying a lot in transportation. And you also want the sources close by to be able to not have supply chain disruptions.
The arrival of one wire harness supplier in a region can inspire other companies to follow.
Once suppliers usually find a home, then other suppliers find a similar home, and then supplier networks build around that, and you have these concentric circles of ideas and supply chains that build around that production.
So some regions of the world naturally develop into hubs.
So for the United States, a lot of it's Mexico, some of it's Honduras and Guatemala. For Europe, a lot of it is Northern Africa, so Morocco and Tunisia, but also German OEMs in particular going to Eastern Europe.
About 22 automotive companies hailing from 6 countries have invested more than $500 million in Ukraine. There are about 38 factories in the country, employing about 60,000 workers. 11 of those companies make wire harnesses, with the rest spread out among other auto parts, such as electronics, seats, plastics, and others. The country is a key supplier, especially for German automakers, such as BMW, Volkswagen, and Mercedes.
It's really mostly the German OEMs like VW, BMW, Mercedes. Those are the ones who have been most impacted.
The dominant constraint is indeed wiring harnesses, so chip supply is at this moment not constraining our operations. Currently we are, let's say, trying to get the most out of the wiring harness production in the Ukraine, but parallel, right from the start, from the conflict, we started to work on alternatives which are on the way.
Ukraine is responsible for about 7% of the wire harnesses that go into European vehicles. While this is a serious concern for automakers that have already faced a cascade of challenges over the last few years, it does not pose the same kinds of threats the chip shortage has.
These supply chains are so mature that there's certain ways around things. Chips are completely different. You couldn't get from A, B, or C. They just didn't exist because they were being used outside of automotive more than they were inside of automotive. But when you have wiring harnesses, yeah, there's going to be some short-term pain.
In late March, some suppliers, such as Leone, had partially resumed production of wire harnesses in the country. Workers, however, had to take breaks to flee to bunkers during rocket attacks. But there are additional challenges beyond immediate supply constraints that are not present with the chips crisis. Automakers with factories or other operations in Ukraine, or Russia for that matter, face longer-term political questions.
When it was chip issues and COVID issues, it was directly related to the supply chain and getting part A to part B. But when it comes to the Ukraine issue, now it's a political event. Now people have to take sides. They have to say either they're sanctioning Russia or they're on Russia's side. How are the optics of that going to affect these automotive manufacturers, suppliers when this whole thing is over? So there's another element on top of it, just more than a supply chain ripple. It's got potentially some long-term impacts it's going to have for those that support the need or those that are against the need.
However, the wire harness shortage is just one of several that stand to affect car makers. The crisis is also posing questions about access to important or even crucial raw materials, many sourced from Russia.
Nickel, aluminum, palladium, platinum, and natural gas out of Russia are big deals.
Russia's largest nickel mining company, Norilsk Nickel, has been trying to ride the rise of electric vehicle enthusiasm in Europe.
Norilsk is a big nickel producer. They produce around 7% of the world's nickel, but they produce about 20% of the world's Class 1 nickels.
Class 1 nickel is an essential ingredient in EV batteries.
Norilsk was positioning itself as a company to be the kind of supplier of nickel into Europe, particularly like European cathode and battery plants. And with that, that's now gone away. That option is no longer really going to be there for them.
Norilsk Nickel, also known as Nornickel, had announced a deal with German chemical company BASF to produce battery materials for the European market. The idea was to localize production and reduce European dependence on nickel from China.
BASF publicly have said that they're not going to sign any new deals, but they will continue to honor their existing deals. So pressure may mount for that to change, I guess, potentially, which will create a medium-term problem for them. I think that plant's due to start early next year. So that would be the major concern in terms of like raw material supply.
There are other nickel sources around the world, but this latest challenge comes amidst a global nickel shortage. The London Metal Exchange had to stop trading in early March after the price jumped 250% in a single day after Russia invaded Ukraine. Tesla CEO Elon Musk said on Twitter in 2021 that nickel is Tesla's biggest concern for scaling battery production.
EV penetration is pretty low right now, so it won't impact a large amount of cars today, but it definitely sets the tone in terms of how expensive it is to make an EV, and the consumer argument of should I pay more for an EV rather than a ICE car? Well, now you have another reason for an EV to cost more money. So that's something near term that could be something that OEMs will have to push pricing.
Also important is palladium, an element used to make catalytic converters, which are required on any fuel-burning vehicle sold in the United States. Along with rhodium and platinum, palladium filters pollutants out of vehicle exhaust. The price of palladium is already an eye-popping $2,500 an ounce, which makes it more expensive than gold. The price has been on a steady rise for the past decade. Prices of elements like palladium and rhodium have contributed to surges in thefts of catalytic converters, often right off the bottom of cars parked even in driveways and garages around the US. Russia contributes about 40% of the world's raw palladium and about 25% of the total palladium in circulation when recycled palladium is factored in. Palladium and platinum are somewhat interchangeable in a catalytic converter, so a palladium shortage can to a point be offset by platinum.
You can find alternative supplies of palladium, notably from China. But the concern here is, one, you'll have to push through pricing to offset the raw material inflation. But the other problem is, if you just can't get your hands on the palladium, you can't make the car.
The effects may take a while to see.
If we're not able to get palladium, for example, out of Russia, in the long term, it doesn't hurt right now. It hurts in price, but it doesn't hurt right now. But in the long term, it'd be very difficult to replace Russia because of the size of their business.
There are shortages even of common materials such as pig iron, partially processed iron used to make steel.
Pig iron right now out of Ukraine is becoming an issue, and everyone's scrambling to buy whatever's currently out there and to talk to Brazil and talk to Canada and talk to Asia and Australia for pig iron. And it becomes a sort of run on the bank affair where everyone's looking to lock up and ensure their supply and are not too concerned about price.
Analysts were already seeing the expected auto production cuts factored into European automaker share prices.
The reaction in the share prices of the group since the crisis began around January 4th, January 5th, it mirrors the amount that IHS cut their numbers by. And actually, if there is further demand destruction from the form of, let's say, a recession happening in Europe, or let's say they can't get the palladium out of Russia, Ukraine, then there could be further downside to the industry.
The outlook may not improve for a while.
It's already faced, a pandemic. Then you had semiconductors, and now you have this third crisis. So, folks are wondering, when will auto production come back to normalized levels? It may not be until 2023, maybe even 2024.
On top of materials and parts shortages, fuel prices have stoked fears of a recession or curbed consumer demand. Russia is a major supplier of crude oil to global energy markets. In the meantime, some firms are weathering the crisis better than others. These are the places investors are looking to park their money.
Some people really want to know what parts of the auto ecosystem are more defensive and what's most vulnerable.
One lesson is, if you have to build cars when supplies are tight, it helps to build very expensive ones, as long as there are customers to buy them. And there appear to be plenty of customers to generate some shockingly high profits.
It's interesting that the premium car makers, some of them actually benefited from the semis crisis because they're able to push through the limited supply of chips they had on higher margin cars. You saw like Mercedes post the highest margin they've ever posted in the fourth quarter of last year. You also have ultra luxury companies like Ferrari potentially benefiting because they're pretty much immune to what's happening in Russia, Ukraine.
Russia's invasion of Ukraine has yielded human costs far worse than supply constraints. But this situation is yet another blow to companies that have been struggling to get back on their feet for more than 2 years. S&P Global's March forecast revision is another example of a discouraging trend. As soon as forecasts turn bullish, another event dashes hopes.
It's been just non-stop supply crises since March of 2020. We got into this deficit world where there is nothing left in the chain, and everyone's working really hard to make every last vehicle.